Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Despite the headwinds of inflation and interest rate rises, there's still been plenty of activity lately in the development and construction sector. Projects of all sizes are still underway, and increasingly they're being funded by non-bank lenders. It's a fascinating space and one I wanted to learn more about. Charlie Robertson is the Executive Director of Centuria Bass, a leading Australian investor and alternative asset manager. Charlie, welcome to Fear and Greed.
Thanks, Sean.
First, take me through what Centuria Bass does.
So Centuria Bass is a private lender. So we specialise in lending to predominantly sort of development industry players and commercial real estate owners. So the three sort of major types of lending we do are construction lending to property developers. We do bridging finance to developers and investors, and residual stock lending. So that's where projects have completed and they've still got apartments or commercial units or industrial units remaining to be sold, and they basically want to refinance out of their construction facility into a term facility.
Okay, so what's the trend in terms of for private lenders like yourselves versus, as many of us would know, the big banks? Obviously, they're big lenders to that sector, but there's also plenty of other banks or people with banking licenses that lend to that sector. So I'm just sort of wondering where we are in the cycle in terms of private lenders.
Well, the trend really started, I suppose, post-GFC, where you basically had most of the sort of foreign banks sort of left Australia and retreated from their positions in the Australian market and property market in particular. And the big four banks were all looking to reduce their exposure to property lending. So a gap basically opened in the market there for private lenders to fill that space. And that has sort of grown since then, since the sort of 2010s, I suppose, and really sort of took off into 2012 and beyond, when the development market had started sort of opening up again and you saw more activity in that space. Then you had APRA bringing in controls over and trying to basically reduce banks' exposures to property development, and that coupled with Basel IV and the sort of international banking regulations has also made lending by the big banks into the development sector a lot more expensive.
Charlie, I've got to interrupt. Anyone that mentions Basel IV on our show gets a rap on the knuckles, right? So
right.
Basically what you're saying is that APRA, of course, is the regulator, and It's the regulator's regulator. So Basel kind of oversees it's a forum for central banks to get together, but they set the rules for lending for banks.
That's right.
And so what you're really saying is the regulator's regulator kind of has made it harder for banks, or more expensive for banks, to lend money to some areas, such as construction in some cases.
That's right. So they basically view construction as higher risk, and therefore they want more balance sheet and capital reserved on balance sheets for it.
Okay. So in a sense, there's an opportunity for private lenders like yourself. Is most of your, you said construction, bridging finance, and I think it was residual stock lending. Whereabouts do you play mostly? Because construction I get, bridging finance I get. I hadn't thought much about residual stock lending, but I'm sure there's developers out there who might build 12 units, sell 6, still need some money to get themselves while they're sort of selling those other units. So, kind of whereabouts do you play mostly, construction, bridging, or residual stock lending?
Well, we really reflect what's going on in the market in terms of what the space is demanding. So in 2022, for example, or 2021, I'll probably go back there to start with. We were doing probably 80% of our book was construction funding. So that reflected the fact that, we had a huge spike in development activities during that period, sort of as the sort of COVID demand sort of built up and you had lots of cheap debt around. People were buying lots of property and we had the big run up in property prices and developers were obviously chasing that. So that was the majority of our book during that period. And then as we moved into 2022, we saw the book swing towards more of a balance between construction and bridging finance. So that's mainly reflected the fact that you had developers having to hold their sites before they could activate their projects and go into construction. So we've done a lot more of that since then. The residual stock piece, that sort of reflects a sort of down market, if you like. So you basically have developers who have completed their projects. They've got enough pre-sales to start construction and get the funding away, but the market has sort of fallen away and they're left with fewer buyers when they complete the project. So they need to refinance, and that's where the residual stock lending comes in.
Stay with me, Charlie. We'll be back in a minute. My guest this morning is Charlie Robertson, Executive Director of Centuria Bass. So basically, you should be I'm sure you are very across the market, Charlie Robertson from Centuria Bass. What is the market looking like? What is the development construction sector looking like? There's been plenty of headwinds, inflation, rising interest rates obviously is the big one, supply chain issues, labour shortages. What is the health of the sector generally?
Well, we're in a phase now that we really haven't seen for a long time, which is where we've got supply constraints, which is leading into material shortages, labour shortages. So that's pushing up all of the construction prices. So we've got rising prices and inflation, and at the same time we've got sort of falling demand. So it's a real sort of double whammy, if you like. You're getting hit both by a lack of buyers for your product, as well as rising costs for your product. So getting squeezed at both ends. So developers are finding it very difficult to make their projects stack up and be viable in the current climate. So a lot of projects have really been sort of put on the back burner. Having said that, it's a very sort of fragmented market, and you really have to look at every sort of location and individual project on its merits. So there are always pockets where the fundamentals all work together and you can make a viable project. And so we're sort of picking those, I suppose, and seeing them emerge. And at the same time, we're seeing a lot of demand from developers who want to actually defer their projects in the hope that conditions improved into the back half of this year, which is what we're expecting.
Is it a better time to be a private lender, I suppose? I mean, I think overseas the figures, like non-bank lending in US and Europe makes about 50% of property lending. I'm sure it's a lot less here. Are these the sort of times, counterintuitively, that it's not a bad time for private lenders simply because they just don't have those Basel guidelines that you were talking about, and there's opportunities for them where there may not be otherwise when the banks are all over the place?
Yeah, well, that's right. I mean, sort of commercial real estate debt market in Australia, it's obviously unregulated, so it's very difficult to find exact figures on this. But most commentators and most of the analysis that you'll read says that the size of the market's around about 400. The total market I'm talking about with the major banks and foreign banks, etc., is probably about 400 odd billion. And non-banks make up at the moment, we think, around about 10% of that, so 42 odd billion. And in the US, they're roughly 60% in non-banks, and the EU and UK, it's probably about 53%. So you can see we're only a fraction of what's going on globally, and we think that trend is going to continue over time, and we'll sort of move, the non-banks that is, will move to something more closely aligned with where things are in the US and Europe. So there's huge growth potential, and I think, as we were talking about earlier, the retreat of the major banks out of property development and construction funding in particular is just going to continue. I don't think they have a huge appetite to come back in and regain massive market share in that part of the market. So, yeah, I think we'd be looking to the market to increase significantly and trend towards that 40-odd% of the total market over time.
So where do you access your capital? Where does Centuria Bass access your money to lend?
So we've got a number of different sources of capital. We run an open-ended fund So that's for wholesale investors. So that's available for wholesale investors to access at any time. They can invest funds in there, and then we place that into a pool of commercial mortgages that'll be across a range of different properties in those three different types that I mentioned earlier: the residual stock, construction, and bridging loans. Then we've got a network of sort of high net worth and ultra high net worth investors that will come in various sort of and form various syndicates as part of our lending. And then we've got access to balance sheet lending via the Centuria parent company.
Of course. Charlie, thank you for talking to Fear and Greed.
Thank you very much.
That was Charlie Robertson, Executive Director of Centuria Bass. This is the Fear and Greed Daily Interview. Remember, this is general information only. You should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.